Good afternoon and welcome to the Coinbase Institutional Markets Call. It is Tuesday, the 12th of December. Now, where has the year gone? I can't believe we're already through to holiday season. And you know what? In a month's time, we might even have an ETF. Who knows? We're going to discuss that and a lot more on the show today. This show I'm particularly excited about. We have a ton of charts that our fantastic guest has put together. So if you are listening on Spotify, we're going to include those charts in the show notes. If you can watch it on YouTube, I highly recommend it. There's going to be a ton of great content. And as they say, a picture is worth 1,000 words. But anyway, David, great to have you on the call today. I know you've been working hard on your year ahead. Are you almost there? Are we almost at completion?
I want to say we are, but there's still a lot of I's to dot and T's to cross.
So do you reckon we could have a podcast next week with your year ahead?
I think so. And, you know, I'm not going to oversell it, but it's going to be the best one we probably had all year.
Very good. Well, I'll say it'll be the best one that I read all year, and I will read many. So I'm very much looking forward to that. In today's show, so we have James Check, lead analyst at Glassnode, who's going to be covering the Bitcoin market rally from an on-chain perspective. He's going to go through derivatives. We've mentioned previously that CME OI is bigger than Binance, which is a fantastic turn of events. We're going to go through the recent sell-off. It's super aggressive on Sunday night. We're going to see what happened on chain there. We're also going to step out a little bit and talk about Bitcoin mining, what we're looking forward to in 2024, and then also take a look at Ethereum with a slightly controversial view, which I'm certainly looking forward to. Alongside that, we have David, Greg, and Josh will be running through flows, macro, and news as per usual. Now, some quick housekeeping. Do not forget to like and subscribe. That is how other people learn about the show. And if you want to see all of David and the team's fantastic research, you can scan the QR code on your screen and you get all of that free of charge right into your inbox. Without further ado, let's get right into it. James, welcome to the show. It's James Check, and I believe your nickname or your moniker is Checkmate. Is that right?
That's it. Thanks for having me on, Ben. Great to be here.
I love it. Checkmate. So does that mean you play a lot of chess, or where did that come from?
Yeah, that's kind of the background, because back in the world of on-chain when it started, which is kind of 2018, most people were pseudonymous. And by the time I got to Glassnode in 2021, I'm just another James, but Checkmate actually had a bit of a following, so tried to bring it along with me.
I love it. I love it. It also, given you're from Australia, that kind of like that mate, the twang as well, it has like a double entendre. I quite like that.
Exactly. There's a couple of layers to it. Yeah.
Very nice. Very nice. So help us understand, what do you do at Glassnode, and how did you get into crypto?
Yeah, absolutely. So Glassnode, we're a data provider, and we really specialize in the on-chain space. And this is kind of a new pioneering frontier of data to really understand these assets. And there's a lot of ways you can think about it. It's kind of the fundamentals, but being able to chart this stuff out. So to me, it's just been a fascinating exploration of market structure, human psychology, how people behave, and all of our collective decisions get baked into this data. So I really found Bitcoin in 2018. I understood Bitcoin in 2019 after paying your tuition. And on-chain was really growing up around that period of time. And it was just really interesting to kind of see new ways to visualize market trends and really just kind of capture market sentiment and investor behavior using data stored within the ledger.
Yeah, I think we've all paid a tuition at some cycle, and we certainly remember all those lessons. That's for sure. So if we go back to the start of the year, there was so much talk about this year being ETH's year, and I think investors were positioned that way. I remember we had a dinner with some risk takers in New York in January, and David and Greg, you were both there, so keep me honest here. I think north of 85-90% of the room were kind of overweight ETH over Bitcoin at the start of the year. And that really hasn't been how it's played out. We've always had a very kind of BTC dominant year. Now others have started to catch up, but that's generally been the trend for the year. So James, as you look at this from an on-chain perspective, what have you been able to take away from some of the things you've seen on-chain with regards to the BTC rally this year?
Yeah, absolutely. So, I've been around this market for a couple of cycles now. And in my experience, Bitcoin does tend to perform in the early phase, kind of in this bear market recovery, let's call it. So really, we opened the year trading below a pretty important pricing level, which is the realized price. So this is one of the oldest on-chain metrics. It's essentially the cost basis for the whole market. And when we look at every coin price at the time when it moved. And what we saw is that level has historically kind of coincided with these bear market lows, and FTX really took us quite deep below that level. And we really opened the year with what was in part a spot-driven demand, but also a bit of a short squeeze. And it pushed us right above that level. It was about 20,000 at the time. Now, when we look at on-chain data, quite often we're looking for, it's the same as technical analysis, we're looking for human behavior patterns. And there's a series of other models. The red one that you'll see on this chart is what we call the short-term holder cost base. This is kind of the average cost basis for coins that were recently acquired. And we essentially switched over from a sell the rip mentality, where people would essentially sell on that exit liquidity, to a buy the dip mentality. And we saw investor sentiment really, really shift as we broke above that level. And essentially that's been a support level through much of this year. So it was that shifting of sentiment. And really, as we got to October, everything up to October very much was kind of just the hodlers that were left. It was very much the people who survived the bear market, very, very little new capital. As we broke above that green price model, which we call the true market mean, it's kind of the center of gravity. It really does trade in the center of Bitcoin's market. Once we broke above that, we started seeing a series of things. Open interest, which we'll talk about later, started to pick up. New money started to flow in. ETF sentiment. So it's kind of been a market of three parts. There was the short squeeze that really kicked things off. There was the hodler-driven kind of spot demand, and we're seeing this new demand influx from October onwards.
Very cool. And just looking at this chart, if I was trying to break that down, the red line, which is your short-term holder cost basis, that's almost like a moving average, is the way I read it. It's kind of like the most recent purchases of those tokens. And then you've got the orange line, which is a realized price average cost basis. That's across the entire market from the start of time. And then you've got the green, which is kind of the midpoint. And the way I read this is that when you've got the short term going below the kind of the average, that's where you're at extremes, almost like a Bollinger Band in some ways. Correct. And that's where you expect it to see it to kind of bounce back up. And I guess in a way you've kind of got like a golden cross when your red has crossed your orange, and actually that's coincided with the uptrend as well. Is that fair?
Yeah, and a lot of this stuff, it all comes exactly. So you're very right there, and it's really describing these different phases of the market. So when we get down near the bottom, there's actually the counterpart to the short-term holders is the long-term holders, and we'll talk about that in the next chart. But what we see at bear market bottoms is it kind of doesn't matter when you got into the market. You could have been in from 3 years, from 6 months, from 2 days. On average, everyone has the same cost basis. So near these bear market floors, you get this almost homogenous mass. And what was that telling us? That it's only the hodlers that remain, the people who really understand this asset and are stepping in at the worst case scenario. And you'll also note here that the short-term holder cost basis, as it declines, that's because people are locking in losses. Coins they bought higher up are being revalued and sold at cheaper and cheaper prices. So you can see that in January, we started to bottom and actually started to trend higher. And that's telling us that people are essentially taking profit. And it means that coins are being revalued higher and higher. And that actually means capital inflows are starting to take place. So not only are those crossovers, but also the trend of these metrics tells you about capital flows in and out of the space.
Very cool. And then so kind of moving on to your next couple of charts here. So you have long-term versus short-term holder supply. Like what is, as you talk through it, if you can just kind of describe it for those that don't see it on video, but what is this chart telling us?
Absolutely. So we use this cohort. This is one of the we call them heuristics that Glassnode pioneered. There's a threshold age for how long a coin has to be held by an investor before it reaches what we call long-term holder status. It's 155 days, about 5 months. And the logic is that once a coin gets to that age, the statistics of it being spent drop significantly. So you can think about these as hodled coins or coins that the market has essentially taken out of liquidity. The other side of the equation, the short-term holders are much more mobile. They're kind of expected to be spent. Now, what we see is that during bull markets, those old hands, people who acquired in the bear market, they start to spend and they transfer their coins from cheap prices to very high prices, and importantly, to newer and less experienced buyers, people who have to pay their tuition, as we mentioned at the start. So you see this kind of inversion where people start to spend their coins, new hands come in, and eventually that oversaturates demand. Now, what we're seeing in our current market cycle is that this long-term holder supply, coins that are really quite dormant, is actually pushing up to continuous all-time highs. So it speaks to a real supply tightness. And the inverse of that is that short-term holder supply are trending down towards what is effectively all-time lows. And that's really telling us that the amount of coins that are mobile, circulating, and changing hands is actually extremely low at this point in time. So it speaks to this kind of level of supply tightness that we haven't seen, technically in history.
Yeah, that makes a ton of sense. I feel like the narrative around Bitcoin as a store of value kind of really holds strong there, and you can kind of see that as people do just hodl. David, I know this is something that you kind of look at as well. I'm curious if you have any thoughts on this.
Yeah, I'm just kind of curious because this is also a metric that I like to look at. But one thing that it doesn't give us is, of course, like when do long-term holders actually begin to take profit? And we've seen this in the 2017, 2018 kind of bear market cycle. Same thing happened in 2022. James, I would just kind of love to get your take on this because, is there some kind of heuristic that you use to kind of give you that indication of when people are going to come into the market?
Absolutely. So there's a couple of heuristics. The first one is traditionally, or at least historically, long-term holders tend to be pretty dormant, actually. They don't do a great deal until we breach new all-time highs. And once we get to that point, they really do start to spend. Now, what I find fascinating about on-chain data is how much there's so much confluence. There's many metrics that kind of tell the same story. And a good example of this, when we get to that all-time high, or whenever the point comes that these long-term holders start to spend, the types of metrics that you'll look for, we call it revived supply. So coins older than 6 months, 1 year, 2 years start being spent. So you'll see old coins being spent. Those old coins will accumulate what we call coin days, which is kind of a measure of how long they've been dormant. So you'll see an expenditure of coin days as like a time volume getting flushed out. And generally speaking, those coins have been acquired at much cheaper prices in the bear market. So people who bought at 16, 20, 25,000 will start to distribute at 60, 70, 80, wherever it ends up going. So you see this realized profit start to come out as well. So this is kind of the power of on-chain data. We can look at it from how much time's getting flushed out, how many coins are moving, are they going into exchanges, and are they realizing large amounts of profit? And as investors, what we do is we look at that information as the supply coming back online. And the other side was, okay, let's look at the demand trends. Do we actually have new people coming in? Are we seeing that there's actually demand flowing in and out of exchanges? Are we seeing transaction volumes picking up? So it's this kind of balance of supply and demand. But there's some of the mechanics that we're looking up on that particular metric.
Very cool. And moving on to your next one. So supply, storage versus issuance. And you've got some like long periods of bear market accumulations here, and it feels like we're just kind of coming out of the third one now. Can you just kind of run us through this?
Yeah, absolutely. So this is a kind of a way to just visualize and put to scale why these, let's call them 4-year halvings. Why does Bitcoin go on these 4-year halvings? So as a bit of a reference point, the orange line there is our issuance. So that's kind of the monthly amount of coins going to miners. Now, what we've got overlaid with it, there's two different metrics. The blue one is long-term holders, and the green one is another measure using coin days, but I'll leave that for now. Basically, what we're looking at is the rate of change over a 30-day period, how many coins are going into long-term holder status. So you can think about this as coins that were acquired and then put into cold storage, waiting for, in theory, higher prices and establishing those floors. Now, what we tend to see is these bear market kind of accumulation periods tend to come in 3 waves where investors actually take coins off the market. The first one is normally fairly early in the bear market, once people are seeing prices come down from, for example, 60,000 all the way down to 29. You get that first influx of people saying, okay, I'm going to grab these coins and take them off the market because they're seeing a significant discount. Then the kind of reality of the bear market sets in and the market goes a bit quiet and things continue to trade down. The second wave tends to come somewhere around the bottom, essentially, because at some point in time, people get flushed out of the market and a series of others actually step in and put the floor in. So it's kind of that next wave of pretty hardy investors that establish the floor. And the third wave, which I think is the most interesting and relevant for us right now, tends to come in anticipation of and through the halving event. So you can actually see where those halving events are marked. And obviously, we've got one coming up in April. So the rationale here is that the rates at which coins are being taken off the market and put into these long-term storage is far in excess of the amount of issuance. So, and again, this is just a bit of a benchmark, right? Obviously, there's coins coming from existing holders and the like, but really it's telling us a story that investors have this psychological behavior where they buy it after a bull market top, they see a discount, they then wait and they establish the floor, and then the halving is this next wave of kind of, momentum and energy that forces them to buy and accumulate coins.
Interesting. So if we've got the halving coming up obviously next year, I guess, what are you expecting to see based on the last three data points that we've had from previous halvings?
Yeah, so thus far, it's and pretty much up until that $30,000 level, very much this market has been spot driven. And we typically see this during these kind of post-bear market hangovers, where a lot of the leverage has been flushed out, and we're really in this kind of spot driven domain. So given the chart we saw just before, where we've got all this long-term supply, I would expect that the hodlers and these people who've been sticking around this market for a long time, they're essentially waiting for, in many ways, they require a higher price for the damage that they went through in the bear market. So it's this kind of, this hodler mentality where people get in, they understand why they own Bitcoin. I think what we're seeing here is quite remarkable because we're seeing the same rate of coin storage and holding, despite the fact that issuance is much less than it was 4 years ago, literally 50%, and it's about to go down again. So in many ways, we have a very, very tight supply. We've got the halving, which is going to reduce the natural sellers, being miners, and we simultaneously have an ETF, which looks like it's increasingly on the horizon. These are all sources of cutting supply or an increase in demand, and at the same time, we have a very, very tight supply. So it could be fireworks.
Thanks for that rundown, James. And I'm just looking at your next slide, I think, if we could put that up, that shows the percentage of Bitcoin supply and profit. And I'm curious to hear your thoughts on how, as you show the supply of profit really surging towards 90%, would the expectation not be that we would start to see these tokens now coming to market and then kind of pushing this market lower? I'm curious, what are your thoughts there?
No, this is a fantastic point, and that's the thing. Fireworks can go in both directions, right? Markets get pretty volatile, and when you get these kind of lower liquidity regimes, things can really go in both directions. And there's a long-standing debate in the Bitcoin space about how much impact does the halving actually have. And I fall in the camp where it actually depends what the USD price is, because if you've got 900 coins coming to market at 50,000 versus 500,000, it's a completely different ballgame of capital that needs to come in. But in the grand scheme of things, it's the existing 19.5 million coins which are owned by somebody that is more likely to create sell side than the miners. So what we're still looking at here, we can see that at the start of 2023, about 50% of the total coin supply was held in a loss. And we have to remember that there's something on the order of like 20% of coins that are actually lost in the first place. So that leaves 30% that was in profit and held by active investors. Now, 2023 has seen that pretty much approach 90% supply and profit. And what we do see is that the path that Bitcoin generally takes is rocky because people start to take those profits. People who bought at 15,000 after the pretty damaging year that 2022 was across all markets, they're going to see 150% returns and be very happy to take coins off the table. So in many ways, we are now entering that regime where coins are in profit, investors will likely start to take them, and that creates a bit more of a trading regime, right? So we can expect a lot of chop. We can compare it to previous cycles. I mean, 2019 is a great case study of this. We had a whole year of chopping around and we almost revisited the lows. So, this is where that trading dynamic and where Onchain Data can help us understand where are those investor touch points.
That's great. Thanks, James. So it sounds like there's a point at which people start to becoming in profit. And by the time we reach all-time highs, everyone's in profit. And that's where you've got your highest potential selling pressure. Like when you think about ranges, where are those ranges that we should start to be aware of enough coins in profit that we're going to start to see pressure on the price and maybe slowing down the pace of a move higher?
Yeah, absolutely. That's a great question. And so the chart that we've got shown here, I've just got some very simple bands on there, just the all-time average in the middle in the green, and then plus or minus one standard deviation. And generally speaking, when we get above that one standard deviation, which we're currently testing at the moment, that's where we move from what I would call an enthusiastic bull to a euphoric bull. right? And as you can see in 2017 or 2021, the market can really move much higher during that period. But you're also entering that zone where, as I described before, long-term holders will start to spend. You'll see realized profits starting to accelerate. So generally speaking, yes, the market's trending higher, but the higher it goes, the more risk starts to enter the system. So where we currently are is halfway between that enthusiastic and euphoric phase. I would be very surprised, to be honest, if we kind of move straight from here to euphoria. I think there's probably a little bit of chop and a bit of uncertainty to go. But we can produce metrics like this, which look at, we talked about short-term holders or long-term holders. We can break down these tools to look at which cohort of the market is more relevant. Do we care about the hot ball of money, or do we care about the long-term holders who are, sitting there waiting for the opportune time? So we can really slice and dice it many ways.
Yeah, I think that seems reasonable, especially with some of the price action last week. As much as we'd like to go up in a straight line, that's just not how markets trade. Now, reflecting back to early this year, there was a lot of talk about the amount of Bitcoin on exchange, and particularly around some of the kind of, I guess, like Silvergate and also some hacks and proof of reserves and things like that, where people were keeping assets either off exchange or on exchange for various different reasons. How does that play into the narrative of price action and what you're looking at on chain?
Absolutely. So the flow to and from exchanges, they are the primary trading venue. So and all those metrics I was talking about before, profit and coin days and volumes, these are all metrics that carry a signature. So when we're looking at coins flowing in and out of exchanges, it tells us a lot about investor sentiment. And what we're looking at in this next chart is just a view of different exchange inflows and outflows across the market. So these are all on-chain flows, orange being Bitcoin and blue being Ethereum. There's a couple of very interesting dynamics that we can pull from this. So the first one, we can see that in both 2021 and also in our current market cycle, we've seen that Bitcoin tends to expand in both inflows and outflows, but it tends to lead. And what we're seeing is just US dollars in denominated value. People are sending coins in and out of exchanges. And this is kind of this uptick in exchange and trading activity. And we're only just starting to see Ethereum actually picking up as well. So what we really see with those exchange flows is it's a bit of a sign of trading sentiment. It's a sign of liquidity coming back into the market and just general interest as people buy and sell. And that kind of creates this liquidity environment that reinforces itself.
Perfect. And when looking at, I guess, realized on your next slide, you've got realized value of net capital change breakdown. And we were speaking about this yesterday on the prep call, and you mentioned a little bit there about like BTC leading the rally, ETH following, and then stable coins last. I guess a couple of questions here. It'd be good to understand that a little better. And then where do altcoins fit into this? Because the narrative in the past has always been BTC, probably ETH / Solana, other L1s, and then kind of the longer tail DeFi applications move last, but most aggressively. So I'm curious, how do you back out those movements from on-chain metrics?
Absolutely. So the metric we're looking at here, I think the best way to think about this, it's kind of like visualizing the risk curve and how the risk curve moves in the crypto economy. So what we're looking at is a 30-day change of the realized cap, or for stable coins, their total supply. So what does this mean? What we're looking at is essentially capital flows. Higher values here means that over the last 30 days, capital has flowed into that asset from an on-chain perspective. And what we tend to see is that these different market cycles, whether it's the two peaks in 2021 and indeed our current 2023, and really from October onwards only, we see Bitcoin see the lion's share of capital inflows. And really, this is a sign of confidence and conviction coming back into the space. Bitcoin, as the market leader, tends to see these initial capital flows. What we then see is Ethereum follows much later in the piece, but generally quite violently. So we've historically seen that Ethereum is kind of that bellwether for risk starting to move out the curve. It tends to flow down from that Bitcoin rally and start to move into other assets. Now, stablecoins, we could obviously plot this for every asset, but stablecoins are a really, really nice framework we have these days because they are the quote currency on both centralized and decentralized exchanges. So, and they also the currency that most people are doing, for example, in DeFi, some kind of borrow and lending, it is mostly dominated by stablecoins. So stablecoin supply is starting to grow is once the confidence has come into Bitcoin and we start seeing that rotation down to Ethereum, stablecoin supplies tend to expand because there's that demand for leverage, there's that demand for borrow, and there's also the demand for trading every other asset in the ecosystem. So it's kind of a bellwether for the risk curve expanding.
So I really like that. I often look at the stablecoins as a proxy for the broader market, and I think that's kind of what you're suggesting here, and that kind of plays out as far as volume in terms of activity, trading activity. We are kind of seeing, though, that the dynamics within the stablecoin market are changing, and some of that has to do with external factors. Some of that just because yield in the real yields in traditional finance are higher. I mean, how does that kind of play into some of the on-chain analysis that you're doing?
Yeah, that's a really, really good point. You're absolutely correct. We've seen a lot of internal shuffling in the stablecoin space. So really, in about July of the last year, we saw a bit of a bottom. There was a bit of a fear about Tether, and there was certainly an expansion in the dominance of both USDC, but also BUSD. And BUSD, for example, has essentially gone into redemption-only mode due to SEC enforcements. And we've seen this kind of turning back of the guard where Tether has gone from a low of about 45% dominance back up to 73%. And most of that is either BUSD, which is in redeem only, or actually gaining market share from USDC. And there's a lot of components here. I think there's some redemption mechanics between these two, but there's also, as you mentioned, a regional difference because Tether tends to be adopted much more in Asia and developing markets, whereas USDC is typically dominant in Europe and American markets. And in Europe and America, there's just easier access to US Treasury rates. So in a world of 5.5% interest rates, a stablecoin which yields nothing for institutional investors is a lot less attractive. So we're seeing both an internal shift, but also some regional differences, which cause these dominance changes.
That's super interesting, James. Stablecoins play such an important role in our markets that we have to remember to keep a close eye on them. Question though, what are you seeing in the derivatives landscape with both futures and maybe in the option market?
Yeah, absolutely. So the derivative space, it really grew up in 2020 onwards. So both stablecoins and derivatives are certainly new evolutions in market structure for this space, and really speaks to particularly recently, an expansion of the institutional interest, because having these access to derivatives, whether for hedging, whether for leverage, but also just general familiarity with futures and options space, it just gives more optionality to institutional investors. And something that 2023 has been quite remarkable. Futures have historically dominated both trade volume and open interest. But 2023 has really seen the rise of the options space. And Deribit is a clear market leader in this at the moment. And we've basically seen that options open interest is now equal to and sometimes in excess of futures open interest. So in many ways, this speaks to an institutionalization, certainly an adoption of option. And generally speaking, retail participants are less likely to be using options in this market because they're just a more complex instrument. But we are seeing a lot more of that activity from institutional players. So to me, it speaks to a real growing maturation. And we can also see this in the futures market with CME overtaking Binance. And this, again, is one of these futures coming back to US regulated markets rather than what's going on in Binance. We're starting to see this market shift structure change over time.
Yeah, I'd agree with that. I think the fact that CME overtook Binance is a really important thing that some of us talk about, but I think we could be a little more vocal about it. And the reason I think it's so important is, to your point, it really does show the way institutions are coming into this market. And we see it every day on the desk with our client base broadening, especially in that segment. So not at all surprising to see this data.
One thing that I was wondering about, James, is that one of the anecdotal story that we've heard this year is that a lot of Bitcoin miners, for example, are using options more to hedge, and that seems to be a part of this. I don't know if you guys are whitelisting some of those addresses so you can kind of see the source of where that option interest is kind of coming from. And if that is the story, do you think that Bitcoin halving could actually materially affect how the derivatives market is going to be impacted?
Yeah, that's a great question. So we don't actually have profiling actual miners specifically. We do have labels for them, but I actually need to check in the data and see whether they're more active in option space. But obviously options are a very, very good fit for miners. Selling covered calls, they have a future income of Bitcoin. Selling covered calls is a very, very sensible treasury strategy for these entities. So I definitely expect that will start to evolve. As we move into the halving, I expect that there will be a lot of volatility because historically the halving has actually been a sell the news event in the short term and a not sell the news event in the long term. And with these instruments, one thing we can do is derive a lot more market information. We can see investor positioning, we can see term structures. We get a lot more information about how the market is considering these events moving forward. So as the market matures, we can now actually look at options as a source of information. And we can really look at how these different dynamics play out, what probabilities look like, and pairing that derivatives data with, for example, on-chain, we really have a quite impressive cross-section of what's going on in the spot markets as well as what's going on in these derivative markets. So at the very least, we're going to have more information about probabilities moving forward.
Amazing. So let's maybe utilize some of that data now and think through the sell-off that we had on Sunday. Obviously, we had a good period of kind of an upward trend for BTC and most other assets. And then we had a sharp move, almost 10% in almost a straight line. So I'm sure you were in Oz, so you get these moves a little bit ahead of us. But what was kind of occurring on chain during that time? And if any of the charts that we've shown so far are helpful, then we can go back to those as well.
Yeah, totally. So I think there's two. This sell-off was the third largest in terms of percent change this year. The other one that I think is quite instructive is the sell-off we had. I believe it was in August. We went from 29 down to 26,000. Both of these were very sharp. Happened over just 24 hours or 48 hours. Now they're both slightly different in the mechanics that were at play. If we go back to the sell-off in August, we looked at a lot. We did a series of reports looking at the volatility, both in the derivative space, but also in the on-chain space. And they were both signaling that Bitcoin was about as quiet as it has ever been, which is quite remarkable, right? Trading at 29,000 and seeing volatility that is all-time low was really quite impressive. The difference is when we move up to our current market structure, we had that volatility because the market was rallying. And instead, what we saw is that same buildup of leverage. So there was a fairly substantial long squeeze. So people were just betting just that little bit too long in the futures market. So we had the same derivative washout. But the difference was, if we look at the on-chain space, in August, nobody was spending their coins. And the rationale here is that all the profits that were going to be taken were taken, and all the losses that were going to be taken were already taken. The market had to move somewhere to incentivize people to spend. This current sell-off, we actually had people taking profits, and in particular, the short-term holders. So we've seen this group of people who've essentially acquired a bunch of coins down there in that 5-month consolidation we had below 30,000. We saw an uptick in profit taking. So not only did you have a build-up of long positioning and leverage in both options and futures markets, but you had the spot market starting to actually sell for the first time that we've seen really this cycle. And that's what I mentioned. As we rally up towards that 90% of coins in profit, more people are going to take action on that. So it was one of these things where you can look at these combinations of data points and get a bit of a read on the space.
So does that mean that we are, each time we get to a similar sort of level, up until we have that 90% level slightly lower, we're going to see some volatility there? Is that how we should think about it?
I suspect so. So my view is that we're probably going to see a choppy road from here on because now that the super majority of the market is in profit, we've kind of left that hodler only domain. And as a result, there's going to be more traders flowing in. There's more, as we saw, there's more exchange activity. So that creates liquidity, which also makes markets, move in both directions. We're also seeing that, the growth of futures and options. So over time, we're seeing that the leverage is increasing, the number of participants, basically the market complexity has increased since October in terms of market participants. So therefore, I would expect a choppy environment. And if we actually look at things on a duration perspective, if we look at it from previous cycles, sometimes it's between about 14 to about 20 months between breaking the realized price and getting back to all-time highs. We're about 11 months into that journey. So that kind of paints a 6-month choppy roadmap ahead of us. And within that, you're going to have all the volatility from the ETF and then the halving. Both of these things kind of speak to there's a few sell the news in there. There's also fundamental positivity. So across the board, investors are going to be betting on one direction or the other. And I think it's going to create a choppy, volatile environment.
Well, as an optimist, I'm going to extract the part about all-time highs from that. And as someone that works at a prime broker, I'm very happy about volatility. So there's two kind of useful things there. I want to switch gears a little bit here and just talk about Ethereum. We've been very Bitcoin focused, and that makes sense because that's led the market this year. That is the largest by market cap. That is certainly where a lot of the institutional traders that we have are focusing their time. But Ethereum is also really important, perhaps on a slightly more longer duration perspective. And I'm curious how you think about that from an on-chain perspective, and any insights that you have around Ethereum specifically.
Yeah, it's a really interesting topic, and obviously one that's evolving because by and large, Ethereum has been a bit of a laggard this cycle. The Ethereum BTC ratio has really struggled since the merge. And as you mentioned at the start of the call, I think a lot of traders were certainly positioned for a positive environment. And thus far, that hasn't quite played out. And of course, that doesn't mean that it won't play out. It may be a laggard that eventually sees those capital flows, and we certainly see that in previous cycles as we looked at before. I think one of the challenges that Ethereum has is on that transition to proof of stake, it kind of entered a domain where it doesn't quite have as much edge against many of the competitors. And that's not to say that we have these Ethereum killers, because that's been the same narrative as Bitcoin killers, right? These things tend to go in cycles. But certainly there's more performant chains out there. And I think in terms of users, the user experience of jumping between L2s, I think, could be quite challenging. Certainly for most, I would say most people would struggle with that user experience. I think there's also some challenges with the security of bridges. And I think another big challenge that the Ethereum project has is many of the, let's call it the moats, is liquidity, users, and developer resources. And indeed, all of those things remain true. But if the layer 2 ecosystem kind of fractures that liquidity because there's no composability between these side chains, and it's harder for users to move between them, and the fees do still remain somewhat high, certainly for new adoption. To me, when I look at this, it feels like Ethereum's game to lose. And that's not necessarily because it's the trade-offs it's made do maintain that decentralization to a greater extent than others. But at the same time, there's lessons learned and things that these other projects are learning, and they're going to make Ethereum run for its money, I think. So certainly that attraction of users will then attract developers, and then that attraction of developers and users creates liquidity. So in that sense, it feels a little bit like it's Ethereum's game to lose rather than the Ethereum's game to win.
That's a really interesting take. Now, how do you square that with, earlier we had a really nice chart that showed that, Bitcoin sort of led rallies and then ETH, violently caught up. We haven't had that move yet. Do you still expect to see that move in this cycle, or would you expect another token to maybe take that place?
That's a great question. And the answer is, based on everything else we've seen with this, the one thing that doesn't seem to die is the cycles just continue to repeat. So I would be kind of going against my best judgment, saying that we probably will see that Ethereum surge. I think the challenge is that as we move into particularly a more institutional focused market, the concept of relative value becomes much more important. I think for most retail investors, they're quite happy if their coin is going up, right? They don't necessarily measure it against all the other coins as much. I think with institutions, that does start to play more of a factor. They're much more aware of doing these relative value trades, right? You can go long one asset, short another. And essentially, as these options and futures markets build out, the possibilities for these kind of strategies gets much larger. Now, that said, there's also there's just simple risk of maturity. Ethereum remains the most mature smart contract platform, and that's obviously going, and also the fees are just less relevant for these institutions. So there's a couple of things working in both directions. So certainly from my perspective, there's a fundamental thesis there. But of course, that doesn't mean that that's how things are going to play out, right? That they may well solve the scaling challenges. Some of these are just technical in nature as well. So one thing I do know is going to be fascinating. And I think it's going to create some volatility, which is going to be great for institutions and traders and people who are kind of looking to look for opportunities in this space.
Very cool. Very, very cool. A very, very broad set of topics we covered there, James. I really, really appreciate it. For all those that weren't watching, I highly, highly recommend you either download the chart pack or you watch on YouTube, because there's some fantastic charts there. And it really kind of helps bring insights to what James was saying. But James, hope you'll stay with us and feel free to jump in for the rest of the course, anything that catches your ear. But thank you so much for your time and putting that fantastic set of charts together as well.
Thanks, Ben. It was an absolute pleasure. Cheers.
Cool, I appreciate it. Now, Josh, over to you. What has been happening in the news?
Yeah, thanks, Ben. Like we just said, what a roller coaster of a week it was. Crypto markets told really two wildly different stories. Things were smooth sailing at first, but then Sunday hit and it seems like all hell broke loose. The moves in BTC and ETH and the ultra well covered, so I'll spend some time instead today walking through some interesting macro and some big market movers this week that really caught my eye. So buckling up, this week is really set to be another wild ride. We've got one last major macro hurdle before the holiday lull. Fresh inflation data dropped today with headline and core inflation coming generally in line. But the main event is Wednesday's FOMC meeting. The Fed is poised to keep rates steady, but markets are still betting on big cuts coming through in 2024. If you couple this against the Fed's own projections via the September dots, they tell a really different story. So I am interested to see what comes of that when the dots drop on Wednesday. But really the main event is Wednesday's FOMC meeting. The Fed is poised to keep rates steady, but markets are betting on big cuts coming through in 2024. If you couple this against the Fed's own projections via their September dots, they really tell a different story.
Yeah, I agree with that, Josh. In fact, I think some of the price action we've seen over the course of the last few days probably are some people who are afraid of the Fed. Not because I think there's going to be hikes in the picture, but if they say anything remotely hawkish or concerning surrounding inflation, I think there's still concerns that there could be a prolonged kind of pause before we get those cuts. But you're right. The CPI came in pretty much in line with expectations. I perhaps, like some people were anticipating that there could have been another move down, but this is in line with a disinflationary trend that we had already been expecting. So for the most part, maybe not surprising, was just kind of like what left people in disappointment. But where I do think we've seen a lot of signal kind of coming from the Fed recently was some of the rhetoric that came from Chris Waller last week. He tends to be one of the board members that had been hawkish. He's moved more to a neutral / I would say slightly dovish kind of stance. And that's important because, he's been a very good bellwether for where the Fed's going to move. I think the only things that probably could distract from the Fed actually being on that path to rate cuts is if the disinflationary path gets disrupted in some way. I don't think that's going to be the case, but we still have some risks going into 2024, like a potential resurgence of a banking crisis or things like that.
David, I just had one question for you on that. So I was thinking, if the disinflationary narrative really does take foot, how would you expect risk assets in crypto to respond accordingly? I feel like, if you look at China and you see what's happening there, that's like one of the few markets where the major indexes are in the red. So of course, there's obviously a lot of maybe idiosyncratic things to that market, but I'm just curious, in a disinflationary world, what would you expect crypto to do?
So for disinflation, at least in the US, definitely, I think crypto would move to the upside, in part because it means there's an accelerated trend towards the Fed actually cutting rates sooner rather than later. And I do actually think that could be part of the story in 2024. Right now, expectations are that cuts will come in May or June next year. But I actually think the risk is to earlier in the cycle. Whereas, we've still seen that Goldman Sachs and some other banks believe it's going to happen the second half of the year. Although that said, Goldman moved it from the fourth quarter to the third quarter of 2024. But I think the chances are that people aren't expecting that there are, in fact, deflationary risks at play here that are not well acknowledged. I think people are still kind of stuck with the first narrative, which is that inflation has been very sticky and it's going to remain sticky, and that the problem is still to the Fed actually being more hawkish than expected. I actually think it's the latter, and that's going to actually reframe the conversation on risk assets and performance next year.
Thanks so much, David. As always, a ton on the landscape from a macro perspective to keep an eye on. We'll go back to news now, but do want to come back to you in a second, David, and just run through the recent survey that we went through. So Josh, over to you to finish the news, please.
Yeah, sure. So in market headlines, crypto flows continue to look positive, with the CoinShares latest weekly fund flows report indicating another $43 million in inflows, with BTC still the darling of the dance. It added an additional $20 million in flows last week. Interestingly, CoinShares did note that there was an increase in short position inflows to $8.6 million. So somebody did well on Sunday on the back of its recent moves. To really highlight some of the week's large token moves, we'll start with the Solana ecosystem and talk about Orca, a DEX which really skyrocketed as trading volume surged over $1 billion. over the last week, more than doubling the week before, which was already an elevated volume week. I think there's a few different reasons for why this price action looks this way. If you look at adjacent price action within the Solana ecosystem, and you see what's happening with other liquid staking protocols like Marinade, which pumped 73% on the back of Jito's new token launch, with Jupiter potentially a major new liquidity aggregator coming to issue its own token. It could just be the case that retail has all of its eyes focused on whether Orca will catch similar momentum upon Jupiter's launch. Really adding fuel to the fire, an Orca proposal to redistribute trading fees passed 98% approval, notably to pass through some of those fees to the Treasury DAO. Helium is also having a big week following news of Helium Mobile's $20 a month phone plan. I'm not sure what you guys here are paying for your phone plans, but when I was kicked off my parents' family phone plan last year, I was shocked to see the sticker price on Text Talk Internet. Long gone are the days of sub $100 plans, so at $20, of course, Helium's product, if reliable, could be quite popular. In other popular alts, we continue to see strong price performance in AVAX and OP, with AVAX processing a bulk of large transactions. This really on top of a lot of bullish news that tokenization of real world assets, which we've talked about here, could take place on Avalanche, including news in November that Republic Crypto would use AVAX to distribute dividends from its venture portfolio to investors. Lastly, I'll just close with in the exciting merge of TradFi and blockchain, which I love to look at. SocGen, which noted that it will debut its stablecoin Euro convertible on Bitstamp. With the majority of stables denominated in USD, it'll be worth a careful follow to see how Coinvertible's market interest fares. On the back of this headline, AXA is said to also have invested in SocGen's digital green bond using the stable. That's it for me. Back to you, Ben.
So Josh, can I assume from that you are now all over the Solana ecosystem and you have a Helium plan? Is that fair?
Well, I think I got locked into a 1-year plan with my iPhone. But, at $20, I mean, quite seriously, when I was looking at phone plans, that's obviously a sticker price that if hotspots work reliably, obviously that's a enticing plan to look at.
So I have it on one of my devices, and it's actually working fine. My understanding is it piggybacks like other MVNOs on the T-Mobile network. So you won't necessarily get priority service there, and you may well get throttled if you use too much data. But I have to say, so far, so good for me. And for $20 a month, it's certainly a lot less than I'm paying my other provider, which I think is probably more like $100. So yeah, I definitely hear you there. Cool. Well, thank you very much, Josh. Appreciate that. Some big movers this week, and mainly in the green, which is always nice to see. David, let's finish off with the results of the survey.
Thanks, Ben. So yeah, I'm not sure how many people caught it, but last month, mid-November, institutional investor actually had a survey on digital assets commissioned by Coinbase. And they actually came up with some pretty important numbers. So the survey actually looked at 250 investment decision makers across different institutional segments, some of whom have allocations to crypto, some of whom do not, or at least they had it in the past. The big numbers to kind of come out of that was that 59% of survey respondents said that they are increasing or plan to increase their allocations to digital assets over the next 3 years. And that was actually up from 32% of those respondents about a year ago. So pretty important numbers to kind of come out of this. Now, in the latest, what we've seen, the institutional investor has actually published an article talking about how these same survey respondents are reacting to the approval or potential approval, rather, of a spot Bitcoin ETF. And what we've seen is that there's very strong support for an ETF among institutions. Around 3/4 of those surveyed said that spot ETFs are actually going to increase their institution's interest in investing in Bitcoin and Ether. And that's actually inclusive of both those who are currently invested as well as those who are not invested. So I think the feeling right now is that the ETF is just a very big step towards regulatory clarity, and it's going to offer institutions a ordained path to invest in crypto. So I would say very striking numbers, Ben.
Thanks so much, David. Yeah, I think these surveys are fantastic. For the 5-6 years I've been in the space, they continue to get bigger and better. And the trends are always pretty positive. Even during downswings in the market, people still want to learn. They're still investing their time. They realize the asset class isn't going anywhere. So they need to educate themselves. So good to see that trend continuing. But that is a wrap for this week. Thank you, everyone, so much for joining us. Thank you, James, especially for joining us and all of the fantastic charts you put together. And also, of course, David, Greg, and Josh for their fantastic insights as always. And last but not least, thank you so much to our fantastic production team as well. With all that being said, have a great week, and we will see you next week. Take care.